Hello, my name is Shreyans and this is a series on developing your equity research process. In this video, we are going to talk about framing our initial observations. So up to this point, we have prepared the financial statements, done comparative common size analysis, also calculated ratios, applied some forensic tools as well, right? So we've done a lot of the quantitative work that could have been done. Now it is time to translate a lot of the work that we've done into observations that can lead us into a further research process. So let's get started. Right. So this time around, we're going to talk about how to frame observations. You need to understand here that we don't really need to write a lot of detailed stuff at this point of time. What we just want is to have an overview of what's really happening, so that once we understand that, we can further research into the company's business to understand why is a particular thing happening, and then we can derive the insights, right? So what you basically need to have is a single line description of basic trends, key changes, or questions, right? So basic trends basically about increasing, decreasing, or stability, key changes, so any changes which have a material amount, right? Or any reversal in the trend, and questions, because these would help us to guide a further research, right? And a lot of times there would be a key change and you would want to ask yourself that, okay, is this key change due to some other underlying factor, right? And this is how basically questions would help us. So now let's take a look at the different financial statements and see that what are the observations that we can make, starting with the profit and loss statement. So you could write about year-on-year comparative growth rate. So we have a 5 or 6 year period, right? So within those 5 or 6 years, we could compare the growth rates from year to year. For example, you can see that if the revenue growth rate in the recent years, how has it been compared to the previous years, right? Because revenue is where from everything else flows, right? So this is also important to look at. Then you could look at revenue versus profit growth rates, right? Because this would quickly give you an idea about the changes in margins, right? If profit is growing at a higher rate or at a lower rate. Then we can look at changes in expenses as percentage of revenue, right? This is something that we can easily take up from the common size statements, and we can figure out that, okay, if any expenses have materially increased versus the increase in revenue, and you can then frame a question that why is that increase, why has that increase basically happened? Or you could also write down about major increase or decrease in any expense. For example, if a company's depreciation has suddenly shot up in any of the years, then you can think about what expansion has taken place, or if the company has purchased any assets, and this is something you can write down as a question and then look into the annual report to figure out what has happened. Same could be the case with interest. For example, if the company takes up borrowings, right? So the interest cost or the finance cost, which might have been negligible earlier, are suddenly have some amount, right? So these are the few things that you can try to understand here. With profit or loss, revenue is the most important thing. So we are trying to compare the revenue and profitability, and obviously the expenses are between the profits and the revenues, right? So this is how we can try to understand that how are the line items in profit or loss statement are changing. Then let's move on to the balance sheet. Now with balance sheet, what I feel is important is that which are the important assets and liabilities, right? So in a lot of cases, you find out the property, plant and equipment is the largest asset, especially with production run businesses, businesses of production nature, right? Because that's very obvious. A lot of services business, you might see that the asset base might be smaller, but there might be a lot of liquid assets with cash or investments. This is particularly true of IT companies as well. So you can think about that, what are the largest and the most important assets. Then you can also take a look at the cash position, the investment position, and the trend in receivables. The trend in receivables could be compared with the trend in revenue. This is also something we looked at while doing the forensic checks as well. But even if we keep forensics aside, then understanding the liquidity position, because cash, investments, and receivables is basically where the short-term liquidity needs would be met, right? So you could compare the position year on year, or the changes, any material changes that might be there. Then we have borrowings and payables, right? So borrowings and payables is the other side, right? So liability side. Now with borrowings, we can have long-term borrowings and short-term borrowings. So you can take a look at that, and from that you could also derive an insight, or write a follow-up question about what is the payment structure of the liabilities, right? And if any non-current loan has been reclassified as current because some part of it is payable in the next 12 months. And then again, we can also look at the trend in payables, and we can also compare it with the increase in the cost of goods sold, right? Because if payables are increasing at a much faster rate, that it means that the company is taking more and more time to pay back, and that might be a problem. Then we have equity growth rates, right? So equity growth rate basically means the book value of equity and how is it growing. And you can compare that with the growth rates in revenue, right? Because I think that revenue and equity are important line items, and you can basically have a look at that. Okay, if the revenue is growing at a faster rate, but equity is not really growing, then it means that there are a few problems that are there in the company, right? Or you would want, if the efficiency of the company is increasing, then the equity might be growing at a higher rate versus revenue, and that might be a good thing, right? And finally, I want to talk about structural changes. Now, these can be important, and when I say structural changes, so this basically means is a shift in the relative importance of the assets. So, for example, a lot of the times company would be owning a lot of assets, right? But slowly it might move from owning assets to leasing the assets, and that is a sort of a change, right? Or a company might basically make some sort of decisions that lead to a change in the balance sheet structure. It might have zero debt, but it might decide to take up the debt maybe to decrease its cost of capital, or because it has a very good funding, it has a very good expansion opportunity available. So these are basically the structural changes if there is any major change. So changes in the largest assets or the liability structure, or how the capital is being funded. So all of these things you could take a look at, right? Okay, now we have the cash flow observations. So with cash flow observations, there's not a lot, but a lot of this would be comparing this to the P&L or the balance sheet. So we have the first thing is CFO versus PAT or EBITDA. This is again something that we did in the forensic checks, right? So this is something that you can take a look at, and you could observe the broad trend of the growth rates of these as well. And then drivers of working capital changes. So when we calculate cash flow from operations under the indirect method, then we have a section of adjustments in changes in working capital, right? So you can take a look that we have also observed the changes in working capital in our balance sheet, right? And here we are basically looking at the cumulative of that, of the total change, and you could identify that which are the drivers, whether it is majorly being driven by receivables or payables or inventory or any other current liabilities or current assets, right? Then we have major investing inflows and outflows, which would be, in most cases, there would be two ways to look at it. One would be the investment into fixed assets or purchase of assets, right? So that would be an outflow, and there would be few assets that might have been sold as well. And the other would be if a company is making any investments into financial assets, and if it is withdrawing or redeeming any investments that it would have made for short-term purposes, right? So those would be the major investing inflows and outflows. So you can again take a look at the broad trend and also take a look at the amount. Then we have major financing inflows and outflows, right? So in most cases, this would be related to the repayment of borrowing. So borrowings would be one important item here. Then dividend would be another important item here. And if a company has raised any new equity capital as well, so that would also be there. But more or less, these would be the major investing or major financing inflows or outflows. Then we have changes in equity. Now with changes in equity, again, there would be changes related to the payment of dividend, the trend of the dividend, then equity issuance as well. So you can take a look at why has equity been issued, and you could basically write that down that, okay, this is something that you need to inspect, because it is not very frequent that companies raise capital except for the banks and NBFCs, right? Then one important thing here are the OCI transactions, the other comprehensive income transactions. So as I had talked about in an earlier video, these are transactions that do not flow through the profit and loss, but are directly recorded in the statement of changes in equity, right? And mostly what you would find here are changes in pension plan obligations, right? And there would be some unhedged portion of changes in the foreign currency, right? Losses or profits due to foreign currency. Now, what one thing you might want to look at here is, instead of just looking at the trend, you might want to look at fluctuations, right? Because, for example, the unhedged portion of foreign currency, now that might really keep on fluctuating. And if the amount is highly fluctuating, then it might also reflect poor management of, exchange rate risk on part of the company, and the other would be changes in pension plan obligations. So again, this is also one of those areas which requires a lot of judgment on part of the management. So if you see that amounts are extremely fluctuating, they're increasing and decreasing rapidly from year on year, then you might want to be slightly more careful about how the company is doing its accounting, right? Because that might be a way to window dress the books, right? So with OCR transactions, don't just look at the amount, but also look at the fluctuations, because that is quite important, right? All right, so that was pretty much it. I want to just quickly do a progress check, because with this we have completed the first part, which is related to the numbers. Next we'll be moving on to understanding the business. But up till this point, these are the things that you should have done. So you should have financial statements in your Excel workbook, the profit and loss, balance sheet, cash flow, changes in equity in separate tabs, and also the different notes to accounts. Then you also have the comparative and common size versions of the financial statements. We'd also prepare a summary version, which we would present in the report, but that is something we'd look at later, right? So we also have done quantitative analysis, which are forensics, comparative common size, and the ratios as well. Please keep the ratios in a separate tab. You can calculate them on the same tab as balance sheet or income statement, but show them in a separate tab as well, so that we can easily move those later into a report. And finally, what we've discussed in this video are the observations and questions. These are very, very important. And please don't worry too much if you don't have a lot of observations, right? Just try to see that what are the basic things that are happening. And that way, what you would be able to do is you would be able to carry on forward with the research that we're going to do. One final thing that I want to discuss is observations relating to ratios, right? So just like we've done for financial statements, you can also write down observations regarding ratios, which I also discussed in the respective videos related to ratios. So just try to look at the broad trend, try to look at the changes that are happening in the ratios, and also try to look at that what are the components that are driving the changes. And similarly with notes to accounts, if you feel that there is anything that is observable or that can be looked at later upon, so you might want to write down a few statements with that respective note if anything is increasing or decreasing, and that might have an impact on our research going forward. All right, so that was pretty much it with respect to the observations, right? Just to do a quick recap, after we've prepared the financial statements, we've done a quantitative analysis, we've done ratios and forensics, then we write down these observations to guide our process forward. No need to write down observations to be extremely long, but just short, crisp sentences about what's happening, because we'd explore and inspect the reasons of these as we move on later, right? Right now we're focused on what's happening, and slowly we'd also move to why is something happening, which is basically the qualitative aspect of it. And then finally, combining these two, we'll be able to derive insights. And finally, after that, we'd be able to move on to valuation. So I hope you've prepared your Excel workbook. If you face any challenges, then please let me know, and I'd be happy to help. So with this, we complete the first part. And with the next part, we're going to discuss about the business of the company, the industry, and the other important qualitative and operational aspects.